All right, as I said before, we're going to look at specifically the employee side of it. What do you, the employee, have to pay on your own behalf? What comes out of your check? And so we're going to be looking at the employee payroll deductions. So what is that made up of? Well, these are the amounts that's withheld from the employee's gross pay. These are the things that makes what you take home, not what you earned, what you think you're supposed to bring home. This is what makes your check a lot less. It's because these are things that you have to pay on your own. And I look at these in a hierarchy. The big thing with these is there are quite a few of these, and I want to make sure I don't forget these. So if I could look at them in a hierarchy to say, okay, who gets paid first, who gets paid second, I'm less likely to forget these. So who gets paid first when it comes to your check? Well, Uncle Sam gets paid first. So let's start with the federal and the state income taxes. That's where I always start. So federal and state income taxes, this is required withholdings that are determined from the IRS tax tables. If you've ever seen the tax tables, they can be a little bit daunting. Most of the time, you're probably not going to have to use those in this class, Intro to Financial Accounting class, because it's not a tax class. Most of the time, they're just going to give you kind of a percentage or just the outright amount. But federal, you're going to have to, and if you're in a state with income tax, then you're going to have to do state income taxes as well. There are a few states out there that do not have state income taxes, Florida being one of them. So if you're in that state, then you don't have to worry about that. But the first one is the state income tax, or federal and state income tax. This is based on the employer's annual earnings rate and the allowance withheld, or allowance amount withheld, which you do on your W-4s. You fill out that on your W-4s. So, first person gets paid, Uncle Sam. Who's the second person gets paid, or second entity that gets paid? Uncle Sam. And so now we're going to have to pay for our Social Security and our Medicare. So that's the FICAs. So FICA taxes, or Federal Insurance Contribution Act is where FICA came from. But it's made up of two pieces. You've got Social Security and you've got Medicare. So Social Security taxes is one part of it. This covers all retirement, disability, and survivorship side of it. And for the year 2021, and this is important to understand because this part does change depending on what year you're in. But for the current year, we're doing this in 2021. Social Security tax is 6.2% of the first 142,800 earned by the employer in a calendar year. Typically, the 6.2 doesn't change. It could, but typically it doesn't. What does change is the cap. You only pay 6.2% of the first 142,800. If you make more than 142,800 in a year, you're only going to pay it on the first 142,800. If you make less than 142,800, then you're going to pay 6.2% on everything that you make. But again, you want to keep up with the 142,800 because again, that does change every year. It's been changing every year since forever, as long as I know. That's Social Security. Now let's look at the Medicare side. Medicare taxes, this covers medical benefits. And so for the year 2021, Medicare tax is 1.45% for the full amount earned by an employee in a calendar year. There is no cap to this. If you make $100, you're going to pay 1.45%. If you make $1 million, you're going to pay 0.145%. Actually, if you make over, I believe, 200,000, then that 1.45 goes up to 2.3, I believe. You just double check me on that because it changes each year. But for the basic, just understand it as 1.45. And that is the Medicare. Now, who gets paid after the FICA taxes? So we've done federal and state income tax. We've done both the FICAs. What's left is going to be your voluntary withholdings. That's if you choose to take something out to pay for or to save up with or whatnot. So this is per employee request, contracts, unions, and other agreements. So if you take something out of, if you paid towards your own 401k, that's what would come out of this. If you paid something for union dues, that's what would come out of this. If you want to do charitable contributions, that's what would come out of this because these are voluntary things that you choose to take out of your check before you get your check to take home. So those are all of the employee payroll deductions. In the next video, I'm going to show you how to account for all this in an example. Thank you.